And joining me in the studio now, someone I know will want to have another go at airlines, fund manager Roger Montgomery. Roger, welcome.
Thank you, Tiki.
Now, Qantas, the Sale Act clearly is not going to go anywhere soon. It's got to get through that Senate. It's not going to make it. So it's this guarantee that Teresa Gambaro was talking about as distorting the market. Yes. But the market's already distorted.
Well, absolutely. It's an unfair, it's an unlevel playing field. There's no doubt about that. Both of our airlines are competing with competitors that get their fuel for free. Or they're subsidised by some other way. We saw New Zealand now owns its airline again. I've said to you before here on the program that ultimately, if the economics of these businesses don't change, and they won't, then Qantas, the safest thing to do is to have Qantas owned by government, have it nationalised. Having a foreign owner is probably not the best thing. We've seen foreign owners of SPC want to close the business down and say they can't support it. We've seen foreign owners of car manufacturing close down car manufacturing. So if it's a foreign-owned business and it's not making any money, well, we don't get a say on whether it stays open or closes.
In the meantime, what sort of impact is the airline industry's business having on other industries?
Well, I'm very concerned that if foreign airlines own Qantas, the bigger impact is on our tourism industry. If it's not economically viable to fly to one of the northern Queensland islands or to fly somewhere inland, then they won't do it. And those entire towns could collapse.
That's very interesting. Let me go to another area that we were talking about today, and that's company profits and how cashed up these companies are. $70 billion in cash. Are they going to be really the growth engine for the future of Australia, or is it just going to sit there in a pile or go back to shareholders?
Well, it's interesting to hear some analysts say, you know, they really need to invest the money now, otherwise Australia will suffer. Well, it's also important from the company's perspective that they invest it profitably. Now, the fact is, over the last 6 months, the payout ratio, the proportion of profits that companies pay out as dividends, hasn't increased materially.
So hang on, is that right? Because I thought there were huge dividends being paid out.
Yes, they raised, 6 months ago, they raised their payout ratios, and we saw that particularly with the banks. But since then, they've maintained their payout ratios. They're not increasing them anymore. Now, what that tells me that they're going to do, or that they're arming themselves to do, is either reinvest in themselves or make acquisitions. And they need to do that at the right price. If they overpay for acquisitions when the market's hot, as it seems to be right now, then they'll end up blowing up shareholders' funds. And we don't want that for any company, because then they're forced to cut jobs.
Do you think a lot of this will go into the sort of areas that the government will want it to go into, like for example,
this is the problem. You know, the problem, everything that we're talking about now with car manufacturing and airlines, and the fact that we're worried about all these people losing their jobs, is a reflection on poor planning for decades. Successive governments for decades have failed to plan for this inevitability. When an industry comes to you and says, we need a handout, they're on their knees, they're on their way out. And it doesn't matter what you do to prop it up, the economics of those businesses don't change. Unless we're prepared to support them and continue to support them forever, then what we've got to invest in something else, or create a tax structure that allows the market to identify other opportunities. But we don't have that in Australia. Other countries do.
Last one on Transfield Services. Now, this is a very interesting situation. They've just picked up another contract as the administrator for Manus Island. They've got a Nauru contract as well, I think. Now, the share price shot up and then back a little bit. What do you make of this contract?
Well, you know, I know when companies are awarded contracts, often the due diligence doesn't involve an assessment of the economics of the business. What's really interesting, when you look over 10 years of annual reports for Transfield and you look at their cash flow statements, what you find is they've invested $2.5 billion over the last decade. And in that last decade, profits have fallen from $70 million to $38 million. So you wonder whether or not it's survived because of the altruism of shareholders and banks, and debt has doubled in that time.
So briefly, this has got to work, hasn't it?
It really has to work for both the company and for the government as well.
Right, risky business. Roger Montgomery, thank you very much for joining us.